Hi, my name is Bo, and on behalf of Group 1, thank you for watching our presentation on Apple and Samsung. I'm sure you've heard of both of these companies and potentially have products from one or both of them. They are the two leading tech companies in the world right now. Samsung's got a pretty diverse product line. They do everything from mobile devices to TVs to home appliances, where Apple's a little more specific to just the mobile devices and computers as well. The market for these products is expanding a lot with the growth of the middle class kind of across the whole world. Mobile devices and these luxury items are more purchased by different populations. It's projected that a third of the world population will have a smartphone in their hand by the end of next year. Smartphones and tablets are diving into areas where they haven't been present before, like Africa and India, and in the Western world. Many countries have over 50% of their population with smartphone devices. South Korea at one point had 88% of their population with a smartphone device. So it's a big market and it's expanding kind of as the world does better and better. More people will have these types of products. As for the two companies, Apple is known for its creativity and the innovation in its devices. It's a little more flashy than the Samsung brand. Apple's done a great job with their brand recognition. People love having the Apple logo on their stuff, and they trust that it's reliable. Samsung, on the other hand, is more of an expert at its manufacturing. They control a lot of their processes, vertical integration from top to bottom, and they do it on a much bigger scale. They sell more smartphones than Apple does at the moment, but Apple has a bigger profit margin for those phones. Apple started in the 70s as a computer manufacturer, which it more or less still is today, but it didn't develop into what we kind of know Apple is until the 2000s. The first iPod was launched in 2001. A few years later, in 2007, the iPhone was launched, which is their biggest revenue source at the moment. And ever since kind of 2001, they've launched something every year. So people look forward to the new Apple products each year. Samsung, very different, started in 1930s as a small trading company in a small city in South Korea. And they just gradually expanded more and more. They were doing things as small as groceries. Found a lot of success in textiles and kept expanding and diversifying. And it wasn't until 1980s that Samsung split off from the other parts of its business to become just electronics focused. And that's what we know Samsung as today: TVs, phones, and stuff like that, similar to Apple. So I'm going to pass it off to Haley, and she's going to talk about the current financials of each of these companies.
Hello, everyone. I'm going to be talking to you a little bit about the reformulated statements, and I'm going to explain a little bit as to why we do this and why it's helpful for investors if the financial statements are reformulated. And then I'm going to talk a little bit about each company, Apple and Samsung, and their respective financials. So the first reason that we reformulate the financial statements is for investor understandability. Sometimes financial statements can get a little bit complicated for the average investor, and so if we reformulate them, then this allows them to understand it a little bit better and make better investing decisions. This also allows them to understand the nature of the business a little bit better. So, for example, breaking assets and liabilities into operating and financial segments allows investors to get a better picture of what's going on behind the scenes. And another example, just real quick, is reformulating the income statement allowed us to quickly realize how profitable or unprofitable a company can be. And in our case, both Apple and Samsung were very profitable. Okay, so I'll start off with Apple. Their balance sheet, we'll start there. They had a net operating assets and a net financial assets, which means that they do not have an excessive amount of operating or financial liabilities that their revenues and investments can't sustain. Okay, next we will look at Apple's income statement. And Apple had a net operating income and a net financial income. And this means that Apple is making more than they are spending, which is what we want to see. So that's a positive. Next, we'll talk about the cash flow statement real quick. And Apple had a decrease in cash flows for the fiscal year of 2017. However, this is not alarming because they still had a positive cash flow, so we still consider them very profitable. Okay, let's look at Samsung's financials. To start off, let's look at the balance sheet. Samsung had net operating assets for the year 2017 and net financial assets 2017. So this also means that, like Apple, Samsung does not have an excessive amount of operating or financial liabilities that they are having to pay off. Income statement is next, and they had a net operating income and a net financial income as well. So, like Apple, Samsung is making more than they are spending. And last but not least is their cash flows. They also had a decrease in cash flows for the fiscal year 2017. And just like Apple, this isn't really concerning because they still had a positive free cash flow. So overall, both companies are very, very profitable companies, and this is kind of what we would expect from companies of this caliber. But I think it was interesting to see when I was looking at their financials that they were very, very profitable, but I kind of maybe expected a little bit more, and I think the decrease in cash flows kind of caught me off guard a little bit. But like I said, as an investor, this wouldn't deter me from investing in them because they still are very profitable. So I'll hand it off to Ryan with the ratio analysis.
Hey everyone, it's Ryan. Haley just spoke about some of the work that she did, and I did some similar work with her relating to the Excel spreadsheets. So I'm going to talk about some of the ratio analysis that we did. We thought it would be a good idea to look into some of the ratios for these two companies, just because while they are similar companies and they do a lot of the same things, it's good to compare numbers within the company. I guess, instead of comparing Apple's numbers to Samsung's numbers, it's good to kind of look into Samsung's numbers themselves and in terms of a ratio, and compare that to Apple, and then compare that to the industry kind of averages to see really how they're doing. Because you can compare the two to say one's doing better than the other, but until you compare that to the rest of the industry, it's hard to know whether that's good or not. Apple may be better than Samsung on one thing, but if they're both worse than the industry averages, then that's doesn't do you a whole lot of good. So some of that ratios that we looked at, just a couple on the list here, are current ratio, quick ratio, gross profit margin, net profit margin, price to earnings, return on equity. So just some basic ratios like that. We did that for both Apple and Samsung. So for Samsung here, we got a current ratio of 2.19, which is pretty good. The current ratio is current assets divided by current liabilities. And for Apple, we got a current ratio of, sorry, it's loading, 1.28. So Samsung was considerably better than Apple in the current ratio, and some industry ratio, averages that I found on the internet for the current ratio is right about 1.7. So that would put Apple kind of below the industry average, whereas Samsung is kind of above the industry average. So again, like I said, we could have just compared Samsung to Apple and said, oh, Samsung's doing better than Apple. Awesome, good news. But until we kind of compare that to the rest of the industry, it doesn't do us a whole lot of good. But now that we can see that Samsung is doing better than the industry and Apple is doing worse than the industry averages, that kind of tells us, a lot more, gives us a lot more information. Another one here that we looked at was the profit margin percentage. So for Apple, was 0.21 or 21%, whereas Samsung's net profit margin was, sorry, bear with me, 0.18 or 18%. So in this case, Apple had a better net profit margin than Samsung, but when you compare that to the industry averages, we get 1.11, or I guess 111%, just kind of depends on how you want to read it. So both of them are below the industry average, and so you can say that Apple did better than Samsung just by looking at their sheer numbers. But again, when you compare that to the industry, it tells you a whole lot more. The fact they're both kind of below the industry averages. And again, this is just from one website that I found. I'm sure there's other websites that would give different numbers, so you kind of got to take that with a grain of salt. But again, it gives us just a lot more information. It helps us compare the companies a little bit more, a little bit better. It gives us something to compare them to. So yeah, that's why we decided to go and do some ratio analysis. Again, you can kind of compare the two. We did a lot more than just the current ratio and the net profit margin. And you can, again, go on the internet and kind of see what the industry averages are, and go from there and kind of base your recommendation or your judgment off of that. So that's it for me.
Hi, I'm Eli, and I'll be talking about the forecast valuation. So we used 3 different methods to get the picture of what this company was like. The first one was the multiples valuation, the second being discounted cash flow, and the third being residual income. Now with the first one, the multiples valuation, we picked a couple different companies for each of them to get a picture of, to be able to compare them adequately. For Samsung, we picked Lenovo, a big player in the smartphone industry, Maytag or Whirlpool, which is going to reflect their home appliance part of their company, Intel to reflect their micro processors or conductor chips, and Sony, which just has a very big influence in personal electronic products. Now from these, we used the enterprise value to revenue, enterprise value to EBITDA, and enterprise value to net income to see if it was overvalued or undervalued. And for Samsung, it was undervalued across the board, which, when taking the average of the different companies' factors. And so this means that Samsung can definitely be a good buy. Now looking at Apple, we had 2 of the same, the Lenovo and the Sony, because they have similar areas, but we also had Microsoft and Dell. Now Microsoft was for their operating systems and also their computers and some other areas as well, but Dell was for the laptop computer part of it, with Apple having their MacBooks and their MacBook Pros and their Macs, their computers and their laptops. Now here it was more of a mixed bag, with the enterprise value to revenue saying that it was overvalued, and the EBITDA and net income methods showing that Apple was actually undervalued. Enterprise value to revenue, because revenue is more constant than some of the other ones down the line on the income statement. It has more weight, but it is still a mixed bag. The next one we went on to was our discounted cash flow analysis, or DCF method. For this, we had to make some assumptions, such as, what's the growth rate? For Apple, some of our assumptions we had was a growth rate of 10% per year for the first 5 years, and then an average growth rate of 2.5% forevermore. Now this was because the current smartphone market globally is growing about 10% per year. And so even with Apple staying constant at their shares in the market, they can still grow by that much. And the growth rate of 2.5% for the terminal is because they can't grow fast in the market, and so we just wanted to put them at about how fast the market would grow. This and some other things like the risk-free rate, just being the rate of treasury bills and bonds. We actually got a valuation for Apple of about $190, saying that Apple is that's what their current value is. The value that we got was $92. And there was definitely a mix from some sensitivity analysis that we did, and they got anywhere from just under $200 to just over $70. But on average, it was about $160. So no matter what, except for one specific case that we did sensitivity analysis on, they were overvalued. So moving on to Samsung. Here, some of the assumptions are just a little bit different, like the market return rate being 8% instead of 10%, and that's just because Samsung is headquartered in South Korea and has a huge impact all over the world in more than one area, in their smartphone and their home appliance and their processors, in all of these ways. And so the market return is just a little bit lower because the global markets are not doing as good as the markets here in the US. A lot of the other things are the same. I think the risk-free rate is actually a little bit lower as well, and that was just looking at the Korean treasury bills and treasury bonds and some of those comparable things. And with this, Samsung was actually undervalued again, with an average being about $97, where their current is about $41. So again, Samsung has been undervalued and would be a great buy. And Apple, it's more of a mixed bag, leaning towards being overvalued, leaning towards a sell. So now moving on to residual income. And again, like in class, this is the most useful of them because there's least variability and just ends up being about what the company is going to be most of the time. So with this, we used all of the same assumptions as we did in the discounted cash flow analysis. But because of some of the ways the numbers interact, Apple actually had a huge increase in what their value was. And Samsung, even though they were still undervalued, did not have such substantial growth. But yeah, Apple was getting close to $300 per share, which is about twice what their value is. And Samsung had about $92, which is less than double their income, what their current price is. But with this, what I was talking about before with the ways the numbers interact, when the shareholders' equity is charged their cost of common equity to see what their charge for common equity is going to be, that is taken using the the cost of equity. And because Apple has been able to keep some of their numbers pretty low, like their weighted average cost of capital and their rate of debts, they are able to take advantage of some of these factors. Like the discounting factor, when you take the growth rate from the weighted average cost of capital, you are able to get a much bigger multiplier to get your terminal value up much bigger. And so this is the reason why I feel like they've been able to get these enormous numbers, closing in on, I think, $1 trillion for their value of the company. But on the other hand, Samsung is still doing very well and with this valuation method. And even looking at some sensitivity analysis with a no growth method for this, they we're still at $88, so they lost a very small portion of it. Where Apple, if there was no growth, they'd lose about 2/3 of that $300 valuation, which is incredible. I mean, and so in this one as well, Apple is a mixed bag where Samsung is consistently undervalued again. So between all three methods, we're seeing a common thread of Samsung having a deep undervalue to their stock prices, indicating an excellent buy, and Apple having mixed results, meaning that it's probably adequately priced. It would be a good one to hold for now, not buy or sell, just kind of see what happens with it in the future, and see what happens. Yeah. All right. Thank you very much. Have a great day.